Hey, my name's Anthony. I'm a trader here at IMC, and welcome to Lecture 2, Trading Options. You might have seen the first video, which touched on IMC, the industry, and a small introduction to market making and options theory. This second video, you don't need to have seen the first video to enjoy it. I won't recover the content on market making that Michael touched on, but anything to do with options theory in this first video will be covered again. It'll also talk about how IMC makes money from trading options, as well as a little bit about how to have a good career as a trader and some of the characteristics that IMC are looking for in our traders. So my name's Anthony. I've worked at IMC since the start of 2019, and I currently trade index options on the Nikkei, which is a Japanese index. This is my first job straight out of uni, and I was studying a physics and finance degree in Canberra at the ANU before working at IMC. In my spare time, I really like running. So the learning objectives from this video will touch a bit about basic options theory to start off with, and then we'll go deeper into why people trade options. It's really important when you trade any product that you really understand why other people in the market actually trade the product that you're trading. Options on the surface sometimes seem a little bit exotic and complex, but if you think a little bit more deeply about it, there are many valid reasons why other people such as banks and hedge funds will trade these products, as well as other market makers like IMC. I'll briefly touch on the Greeks, which are some characteristics that options contracts have. If you've studied econometrics or maybe quantitative finance at uni, you might have seen these before, but I'll try and cover them from a more practical trading standpoint as opposed to a mathematical derivation. And near the end, I'll touch on a concept called skew, which is maybe a slightly more advanced options topic. And then again, we'll finish with some of the skills of a successful trader at IMC. So trading options. Options are just contracts. These are contracts between two parties, and they give a right, but not an obligation, to trade an asset at a fixed price at a date in the future. So you've got call options and put options. Call options are the right, but not the obligation to buy an asset in the future, and put options are the same right, but again, not the obligation to sell the asset in the future. So throughout this whole lecture, I'll mainly focus on call options, the right to buy. So we can start off thinking about an option on Rio Tinto. This is a mining stock in Australia. We can talk about here the Rio Dec 95 call. So explaining a few bits of, what this nomenclature or this notation means. Rio, this is the underlying of the contract. It's a stock. You can get options on many different underlyings. Most stocks in the ASX or in the US will have options on them. Similarly, indices like the ASX itself, the Nikkei, the ES in the US, these all have option series. And even further, things like commodities and currencies have options on them as well. So options exist on many different underlyings. Excuse my handwriting. That's not one of the trader characteristics I'll be touching on at the end. Dec here is the expiry date of the option. So it talks about the right, but not the obligation to trade the underlying at a price sometime in the future. This defines when the future is. So this won't just be Dec, it'll be a date. Let's call it, I don't know, Dec 20th. I'm not actually sure whether that is a trading day or on the weekend. But so this says, okay, come the 20th of December, that's when, if you hold this call option, you have the right to buy the Rio Tinto share. So yeah, we call this the expiry date. We now have the strike price. So we have the right to buy Rio at some point in the future on the 20th of December for a price. So this says, okay, I can buy this share of Rio for $95. And then finally, the type of the option. Is this a put, the right to sell, or a call, as it is here, the right to buy? So we can see here, this kind of introduces the idea of many different option series. We can have different options. We can have options on different underlyings, and then for one underlying, we can have options across different expiries. For each expiry, we can have options on different strikes. So maybe for Rio Tinto, I think that trades about 100 at the moment on the ASX. We can have options maybe from strikes 50 all the way up to 150. And then for each strike, we can have either a put option or a call option. There's one other aspect of these that often isn't in the notation of the options, but this is something called a contract size. So generally, this is 100, which means one option gives you the right to buy 100 shares of Rio Tinto. This isn't that important, but we'll touch on it again just in the future on a later slide. So if we think about this call option here, this Rio Dec 95 call, when do we make money trading this option? And we can think about this in terms of what we like to call a payoff diagram. So come the 20th of December, when does this option make money? We can think about here the price of the Rio Tinto share, the underlying on the 20th of December, and then here the value of the option. So this is a call on the strike price of 95. So if Rio Tinto is trading 95 on the 20th of December, do we think this option's worth any money? Is there any need to go and buy Rio Tinto for 95 from your counterparty when you can just go to the market onto the ASX and buy Rio Tinto for 95 there? And the answer is not really. It's worth zero. Similarly, if Rio Tinto is trading at 90 in the future, on Dec 20th, why would we ever exercise this contract? Why would I go to my counterparty and try and buy Rio for a price of 95 when I can go into the ASX and buy the same stock for a price of 90? A lower price, and as we said before, we like to buy low and sell high to make money. So given we can buy for a lower price on the exchange, we wouldn't exercise this contract this time. So again, it's worth zero. So I'll use this red whiteboard marker to draw out the payoff diagram of this call option. So we see it's zero through the strike price of 90, and at 95 with the underlying there, also worth zero. What about if this Rio share is worth more than 95? What if it's worth 100? So on Dec 20, if this Rio share is worth 100 on the market and the ASX, this option is worth something. I can go to my counterparty on this day and say, okay, I'm going to buy my Rio shares for a price of 95, and then I could immediately go to the market and sell them for 100. That means I make $5, and this gives this option contract a value of $5. If we think about it a bit more, we can see that would be linearly extrapolated through all other Rio prices. So as on Dec 20th, if the price is above 95, we can see this call options contract has a price, or has a value rather, a non-zero value. But when the price of the stock is less than 95 on expiry day, it expires worthless. So we call this region here where it expires worthless out of the money. Similarly, as the stock price is 95, this is at the money. And as the stock price moves above 95 into the point where the contract has value, we call this being in the money. So if you own a contract and it expires in the money, this means you exercise it and it has a value on expiry day. So I've got another exercise here on these slides. What if you want to try and draw the payoff diagram for the Rio 95 put? Have a think about what you think that would look like. So again, I'll use this bit of the whiteboard and just make these quite small. If we buy a put, again, at 95, the contract has no value. But now, if the Rio price is 100 on December 20th, the put has no value. Why would you want to sell the stock at a price of 95 against our counterparty when we could go onto the ASX and sell it for 100 at a higher price? This is better for us. So again, this has no value. Similarly, if Rio is trading at 90, this put option does have value. We can sell it for 95 against our counterparty and immediately buy at 90 in the market, making $5. So we can see the put option payoff diagram is flipped here on the x-axis. And it looks something like this red line. This is buying a call. And this is buying a put. Again, what if we were to sell these contracts? Well, you're just trading one contract against a counterparty. Trading is a zero-sum game. So what do the payoff diagrams look like if you want to sell these contracts? So if we were to sell to sell the call, we would want to flip this payoff diagram around the y-axis. As the stock price goes up, we actually lose money selling the call. And similarly, selling a put is the opposite of buying a put. So hopefully that makes sense, and that's some basic payoff diagrams of these different types of put and call options and whether we buy and sell these. You might think about this though and then say, okay, if I buy a call, I either make nothing, zero, or I make money. Similarly, if I buy a put, my payoff is either zero or I make money. So why would I ever sell an option? Because I either have zero or I lose money. And that doesn't seem like a particularly good trade. We've just focused here on payoff diagrams. In reality, options always cost something. So if you think about a profit and loss, when you buy one of these call options, you actually initially pay money. And selling it receives money. And then as we move up through this strike price in the money, we then start making money. So if we buy an out of the money call and it stays out of the money, we lose money. So this isn't a risk-free trade buying an option. Because we're buying it and they're worth something, we have to pay money for it. So we focused here just on the payoff diagram of the call on December 20, 2021. I'll draw this here. What does the payoff diagram of this call look like today though? This is on expiry day, but we're trading these now in the market. So what do we think they're worth? So we can see that the payoff diagram, or we can think that maybe the payoff diagram of this call today looks something a bit more like this. I'll just mark that now as now. So this blue line, this is a little bit more mathematical, a little bit more probabilistic than just these straight lines of the payoff diagram of expiry. So why do we think this line's curved, and why does it differ from the straight lines of the payoff diagram of expiry? Well, we think about it now. So we can see it when Rio is at 90 on expiry day, the option's worth nothing. But if it trades at 90 now, do we think there's still a chance that come the 20th of December, this option will be in the money? And there is, right? There's a chance that the stock will go from 90 and move above the price of 95 in the 8 or 9 months that we have until expiry. That can happen. And that means this option is actually worth something now. It's not just worth zero. Similarly, the option that's at 100, the Rio stock could still continue moving up. This gives the option some more value. And so we see it we can see at every point, the payoff diagram of the option now is higher than the payoff diagram on expiry. Before we go a little bit deeper into the difference between these payoff diagrams, I'd like to quickly touch on why people actually trade options. So there are a few parties that trade options. We can think firstly about maybe a hedge fund or a super fund and why they would want to trade options. So something like a super fund, they generally just buy stocks. We all pay super into a super fund. They've got a lot of money. They want to invest it. They generally buy stocks. What do you think the payoff diagram of just being long stock is? Rubbing out these ones. For a long stock, it should be kind of clear that the payoff diagram just looks something like this. As the stock goes up, we make money. As it goes down, we lose money. But for someone like a super fund or a hedge fund, they probably don't want to lose a huge amount of money if all the stocks they're holding go down. If something like coronavirus happens again where the markets tank, these funds are really exposed to large down movements in the market. So maybe they want to hedge their portfolio. Thinking about the option payoffs that we had here before, which one of these do we think would be best to hedge this long stock position? And we can think about hedging or holding two positions at once as like superimposing the payoff diagrams of two different positions. So we think now, okay, maybe if we look at the buying put payoff diagram that I had before, and I superimpose that on the long stock position, let's look at what that looks like. So I'll draw the long put payoff diagram in blue. So we can see here that if we buy a put, now this superimposed payoff diagram of the portfolio, we still make as we move up, but then as the stocks keep moving down, the money we make on being long the put offsets the amount of money we lose being long the stock. So our portfolio doesn't actually end up losing money as the market goes down. This is a process called hedging, and it's a fundamental reason why people buy stocks. Similarly, if you own the Rio Tinto stock, it's currently at a strike price of, it's currently trading at a price of like 95 or 100, but we think, okay, I don't believe the stock could go above 120 or 130. And if I'm wrong, I'm happy to not make any more money. You could sell a call, and if you superimpose those payoff diagrams, maybe think about this in your own time, you can see that you can receive money for selling the call, cap your upside gains, but if you're happy to not make any more money when the stock goes above that price, you can make some additional income if the stock doesn't. So this is called hedging a portfolio, and is a reason why a lot of hedge funds and super funds will trade options. We can also think about, what if we're long the Rio stock, trading around a price of 95, but we think, okay, if the Rio stock goes above 120 or 130, say, I'm happy to not make any more money, but I can receive a little bit of income if that happens, or unless that happens. Thinking about the payoff diagrams we had on here before, and superimposing those, maybe think about this in your own time. We need, if we sell a call while we're long stock, we can cap our upside, but because these calls cost money, we can sell these calls and make some money. And so as long as the Rio stock doesn't go above 120, we can earn an additional bit of extra income. And if it does, we think, okay, I didn't expect this to happen, but I'm happy not to make any more money in that scenario. So that's something called enriching a portfolio. And is another reason why these super funds and hedge funds will trade options. Just looking at the slides here, a few of the other reasons why people might trade options are some Delta 1 speculative strategies. So this is something we've seen a lot in 2020 and 2021, the rise of retail investors. Maybe you've seen Wall Street Bets or GameStop on the news or on Reddit, the internet. People use options, they like them because they're leveraged. This idea of a contract size, meaning that you trade one option, you get the exposure to 100 stocks. And so people use options to take directional bets on the price of a stock. We can see here, okay, cool. We buy a call and essentially if the stock goes up, we make money. Nice. People like that, and it means they can cheaply leverage themselves, which means they can make or lose a lot more money than maybe they could afford to otherwise if they were just trading stocks. There's also some statistical arbitrage strategies. IMC doesn't really involve itself a lot in these, but these are things like trading other products against options. So maybe bonds v options or swaps v options. Other reasons why people participate in the market. And then we have these ones down the bottom, volatility trading. These are the strategies that IMC is most involved in. So market making, we've touched on that in lecture 1, the concept of market making. So we do that with options. And then also volatility position taking, and then statistical volatility arbitrage. So I'll touch a little bit more on position taking and market making and how we make money trading options later on in this lecture. So going back to these two payoff diagrams we have here. We have the payoff diagram in red on expiry day, deck 20, and the payoff diagram in blue for now. So we can think, what's the difference between these two? So firstly, options carry in both intrinsic value and time value. So we can think of intrinsic value the intrinsic value is the stock price minus the strike price. and it's the maximum of this and 0. So we can see this just follows the payoff diagram on expiry. So we have here, this bit is the intrinsic value. We'll call this I. This is pretty easy to calculate. It's a subtraction, leads to these straight lines. On top of intrinsic value, options also have time value. So this is what I was talking about before, where Rio Tinto is trading 90 now, but there's a chance that it could move above 95 and could move to be in the money. And how do we value that? This is a lot harder. This is a lot more probabilistic and relies on how we expect the stock to move in the future, and a bit more calculus and a bit more advanced mathematics. This is why options, I guess, are a bit more interesting and a bit more complex. It's this time value. So we can see here, if we have this intrinsic value here, I, the rest of the options value, the difference between the red line and the blue line, this is the time value. I'll call that TV here. So what does the time value then depend on? So we can think of a few variables here, and maybe you could spend a second just thinking about, okay, what do I think the time value of this option, this gap between this red and the blue line, will depend on? So rubbing out the definition of intrinsic value, we can think that the stock's price, V, is a function of a few variables. So we know that clearly the stock price and the strike price must be two of those, because the intrinsic value is derived from these. What about some other ones? So maybe the time to expiry, T. If we've got further between now and expiry, we think, okay, maybe there's more room for the stock to move, the option should be worth more. Volatility, sigma. This is the main risk that IMC trades. I'll touch on that a bit later on in this lecture, but this is related to how we actually expect the stock to move. So a high volatility means we think the stock will move more. And we think about in this example, if we expect the stock to move more, the option is going to be worth more. If Rio is trading 95 now, but in the last 3 years has only traded between 94 and 96, it's a pretty boring stock. And similarly, it's pretty unlikely that come December it's going to be trading at 100 or 105. So options that have their strike price above here probably aren't worth very much because it's really, really unlikely that they'll expire in the money. Compare that to a stock like Tesla that's traded, 200 up to 900 down to 700. That's moving so much. That's got a high value of volatility. And options on Tesla are worth a lot more because of this, because people are really uncertain where the stock price will be 8 months from now. There are a few other factors here, like interest rates and dividends. These generally aren't as important. Depends on what you're trading, but generally aren't as interesting, and I won't focus on these too much for now. But I've got an exercise here on the slide, so deriving the sign of the stock price for both calls and puts for a bunch of these variables. So I've just discussed a lot of these for calls. So I write here for calls, and for all these, these underlying variables. As these change, how's the price of the call change? I'll change that to V to keep my notation consistent. As the stop price goes up, obviously the price of the call goes up. We can just see that these payoff diagrams trend up as we move to the right. What about if we move the strike price? We can think here, okay, we've got a payoff diagram here for the 95 call. If we have the 100 call, maybe that's similar to just translating these payoff diagrams $5 to the right. Okay, think about that. The options are going to be worth less. Because instead of having the value of here, that they do currently, given these value here, they do at 95, they'll have a value about $5 of stock price lower. I've touched on volatility and time. These both make the option price go up. And then finally, there's rates and dividends. So have a bit of a think of these, maybe have a Google, and I'll just write down here that dividends cause the price of a call to go down, and rates cause the price of a call to go up. This is for a call. In your own time, if you're interested, maybe think about what all these values would be like for a put. Some of them are similar to a call, and some of them are flipped. And think about why that is. So we've got these sensitivities of price, these underlying factors. These are more commonly known as the Greeks. And so some of the more common ones are the sensitivity of the price to the volatility. This is called vega, which isn't actually a Greek letter. The sensitivity of the price to the time remaining in the option. This is something called theta. But one I'll focus on now for a few slides is the sensitivity of the price to the price of the option to the price of the stock. This is a Greek we call delta. So yeah, mathematically, it's the partial derivative of the function that we use to calculate the price of the option with respect to the price of the stock. But there are a few more ways we can think about delta, and maybe these are a bit more fundamental or philosophical ways, and probably ways that are a bit more applicable to actually trading. So there are three different ways we can think about delta here. Firstly, it's the probability that the option will land in the money. So we think, okay, cool. We've got maybe three options here at a strike price of 90, 95, and 100. So if we firstly just think about the partial derivative of this equation here for delta, we can then maybe draw tangent lines to the payoff diagram and think, okay, that approximates delta. That's approximately what the delta is. So rub these off and just redraw the payoff diagram for the option now. I'll ignore the one expiring on deck 20. Cool. So we've got this payoff diagram now. So at a strike price of 90 or below, we think, okay, the tangent line here it's a pretty flat slope. Maybe it's got a slope of 0.1. Similarly, very far in the money, at a price of 110 or 120, we can see this moves pretty much one-to-one the value of the option and the value of the underlying stock. And at the money, at about a price of 95, this slope is about half. So yeah, I just said before, you can think of the value or delta as the approximate probability the option will land in the money. And that makes sense now if you think about here. If the Rio stock's trading at 120, the chance that the 95 call will land in the money, or that on December 20th, the Rio stock will be above 95, is pretty high. It's almost 1. We think it's pretty unlikely it's going to lose 40 or 50% of its value by expiry day, delta 1. Similarly, for these lower strike price options, strike of 80, strike of 70, these have a delta much closer to 0. Because we think, okay, it's very unlikely that the Rio stock price will move above 95 by expiry day. It's most likely these will expire out of the money. And then it should be quite clear that the delta of the at the money option is about 0.5. There's a 50-50 chance that the option could move up above 95 or down below 95, where it's trading at the moment on expiry day. We don't really have an opinion on the movement of the stock. We just think, yeah, call it a 50-50 chance. It'll be higher or lower than it is now 8 months in the future. The second way we can think about delta is the one that I've already touched on, and this more graphical one here is the derivative of the options price with respect to the stock price. And then the third way we can think about delta, which is, I guess, maybe the most fundamental or the way that's most relevant to trading, is the amount of stock needed to hedge the trade of the option. So we can see here, by this payoff diagram, if we buy this really far in the money call, we have a lot of exposure to the stock price. As the stock goes up, the value of the call goes up essentially 1-to-1. We don't really like this exposure at IMC. We're not trading these options for a directional bet on the underlying, so we often want to hedge this delta risk away. So if we buy one of these far in the money options, we have to trade one by the contract size, so 100 Rio stocks to fully hedge this directional risk. Similarly, if we buy a really far out of the money call option with a delta close to 0, we don't really need to trade many stocks at all to hedge the delta risk because as the stock price moves, the price of the option doesn't change very much. And if we trade an at-the-money call, we want to sell about 50 Rio shares, and that will give us what we call a delta hedge portfolio. So I can draw this on the board here. In red, we sell 50 Rio shares, gives us a payoff similar to this. And now we can see for small moves in the Rio underlying price, we don't actually make or lose any money as the stock moves. As the call goes up, we lose money on the Rio shares we've bought. And then as the stock price moves down, on the Rio shares we've sold, we lose money as the price goes up, we make money on the call. And as the stock price goes down, we lose money on the call that we bought, but we make money on the shares that we sold. For these smaller moves in the stock price, we call it a delta hedge portfolio. This does break down as the stock moves larger amounts. This is something I'll touch on in a later slide. So why do we want to trade these options delta neutral? So if we hedge this amount, we call this a delta neutral position. And this means then that we can say that calls and puts are pretty much equivalent. Because if we go back down to this value of the option, this is a function of all these variables. We've already said that rates and divs pretty much aren't important. If we think about, okay, we want to hedge more of our positions. The time to expiry, you can't really hedge that. You can't stop time. Consider that hedged. Hedging the strike price doesn't really make sense because that's a fundamental aspect of the option you're trading. So now we're left with two risks. The change of the call contract with the change in the stop price, and then also volatility. I've just discussed how we can actually hedge against the price of the stock moving. This delta hedge portfolio hedges this risk. And this means that we're really just left with one unhedged risk, the volatility of the option. I said before, this is the main risk that IMC likes to trade. And in this way, when we hedge the deltas of the option, calls and puts are both related to volatility in the same way, if you thought a little bit more about the exercise I put up on the board before. And this means that calls and puts are pretty much equivalent when we trade them in a non-directional way. If you're on Wall Street bets trading options, they're very, very different. But in IMC, or I guess a more sophisticated framework, when we're trading them for exposure to volatility, calls and puts are equivalent. And this is the position that IMC wants to be in. We only want to be exposed to volatility, the risk that we trade. And this is good in a theoretical framework. We can talk about buying options and we can talk about selling stock and hedging these positions. But in reality, IMC isn't here to draw theoretical things on the board. We're here as a trading company to make money. That's the goal of the company. And so there are three ways that IMC makes money trading options. And these are kind of, the goals of trading options. So you can market make. This is something we've talked about in the first lecture with Michael. And this is to do with taking credit and then unwinding your risks at a lower credit. So these ways are, I guess, on the slide. There's a second way called making money on implieds, where the risk that you're exposing yourselves to, say volatility in this case, move in your favor. And then the third way is making money on realized, where the underlying price, I guess, moves in your favor. The realized case is something we'll touch on a bit more for options in a later slide. But for these three cases, market making, making on implieds, making on realized, I like to talk about these in a non-trading example first. So maybe many of you are familiar with sports betting, an exchange like Betfair. We can bring all these examples into a betting framework as well. So the Australian Open was just on, and say at the start of the tournament you thought Djokovic was a good bet to win the tournament. You go onto Betfair and his odds are $2. So that implies a probability of about 50% that Djokovic is going to win the tournament. And so you can back that or bet on that, but in Betfair terms, you can back it. So if you were to market make, you could think, okay, I think 50% chance is a fair probability. Maybe I'll make a market around a probability of 45, 55 and have some quotes there. Hopefully this terminology is familiar to you. If not, I'd recommend maybe you go back and rewatch lecture 1 in your own time. But you put some quotes on a bid and an offer, 45, 55, and you can trade around this theoretical price, take some credit for these trades that you make, and hopefully make money on a low risk position just by buying and selling around your theoretical. That's quite clear. What if you want to make money on implieds? So we bet on Djokovic, this probability of 50%. Now if, Nadal, Federer, if these guys all pull out of the tournament, or maybe news comes out that Djokovic is training really well, the probability of him winning the tournament goes up. Maybe it goes up from 50% to 60% or 70%. And so this bet that we've made on the probability of 50%, $2 odds, looks much better. We've made money here as the parameter that we're exposed to, the probability of Djokovic winning the tournament has moved in our favour. And this is before he's actually played and before the tournament's finished. So we haven't seen the bet out to completion, just the risk we're exposed to has moved in our favour. This is called making money on implieds. And then finally, making money on realised. The betting equivalent of this is betting on Djokovic to win the tournament, waiting for the tournament to end. In this case, you would have won. He won the tournament. And then you either get your payout when he wins the tournament, your $2 odds, or you get nothing and you lose your money. So yeah, we've got these three kind of ways that IMC makes money trading options in a betting framework, but now we can also talk about it in a more options relevant framework. So talking about market making, IMC is traditionally really good at market making. You quote prices around a theoretical price, and then you receive credit for your initial trade. You then look at all the risks you're exposed to in this trade. So coming back to this price function with all these variables, you look at all these risks. Okay, I'm exposed to the stock price, I'm exposed to volatility, and maybe I'm exposed to rates and dividends, but we'll ignore those for now again. And now you want to hedge these risks, exactly what we've spoken about before. So, okay, I've bought my call, I want to hedge my exposure to the underlying, so I sell some stock. That costs a little bit of money. Maybe you have to pay to cross the spread in the stock, and there's also transaction fees we often have to pay to the exchange. But you've hedged your stock, you've hedged your delta risk, and now you're just exposed to volatility. How can we hedge that? Well, we know that both calls and puts, these are, as volatility goes up, the price of these options goes up. So maybe we could hedge our volatility risk by selling another option. Say we do that, and we've got this perfectly hedged position. We've hedged our delta and our volatility risk. Now, if the credit we took on the initial trade, so the price we paid or the price we bought for compared to our theoretical, is more than the cost that it took us to hedge our position, to trade our stock, to trade the options, the transaction fees, we've made money and essentially have a riskless position or a riskless portfolio. This is something that IMC is traditionally very good at. It's our bread and butter. But I've just talked about, we buy this option, then we have to trade a bunch of other products. We've got to trade stock, we've got to trade other options to hedge these risks. So what kind of market do you think works really well for this strategy? We want a market that's really tight and very liquid. So there's lots of bids, lots of offers. We don't have to pay a lot to aggressively take a position like we do to hedge. So often for index options, especially ones in the US on indices like the S&P, NASDAQ, the index I trade, the Nikkei, IMC is quite good at this because these markets really play to our strengths. They're very liquid, and these transaction costs to hedge the risks are very low. But in some other markets, so maybe even Rio Tinto, for example, a lot of equity options, these markets are a lot thinner, the transaction costs are a lot higher, and they're far less liquid. This means market making often doesn't work as well because the amount that we have to pay to hedge these risks is often higher than the credit that we take. So if it doesn't work that well in these illiquid markets, we either need to be better at finding hedges, smarter about how we hedge, or move to a different kind of strategy. So maybe something more statistical arbitrage or a position taking strategy. We can also talk about making money on implieds. So this was the example where you bet on Djokovic and then Nadal and Federer both pull out of the tournament and Djokovic's odds or his probability of winning moves in your favour. So we can go back to this price function now. So we've bought the option. So we've hedged our delta risk. So we're just exposed to the volatility. And now other market makers think that the volatility should be higher. They start moving all their prices up in the market. Yeah, the way that we calculate volatility is generally reverse engineered from the market prices. So we say, okay, the market has a bid and offer for this option. We can then take all these pricing inputs and the price and then use a function to then calculate what we think the implied volatility is. So other people in the market think volatility should be more expensive. They move their prices up, and then the price of the option that we bought will move up. So the parameter that we're exposed to, in this case volatility, has moved in our favour without us trading at all. And we've had some unhedged risks, and these risks have moved in our favour and we've made money. This is called making money on implieds. The final example is making money on realised. And so this is a little bit more complex. The idea here is that you can hedge your deltas, but then as you move, your position becomes unhedged. So redrawing this payoff diagram here on the board. In the slides that come up, I've already worked out this example, but I can just talk through it, but yeah, maybe the maths should be kind of clear. But so yeah, we've bought this at the money option, so delta 50, and we've bought 50 of these options. So we've hedged this by selling 2,500 Rio Tinto calls, and the stop price is currently here at 95. Now, if the stock moves tomorrow up to 96, we've sold some calls, but we see the delta of the options actually increased. So we now have a long stock exposure. Our position isn't actually hedged because the delta we sold is different to the delta the option is trading at now. So we want to sell some more stock to hedge our portfolio at this new stock price of 96. So we sold some stock here. We'll sell some more now. The next day, the Rio stock tanks, goes down to 92. The delta of the option will move to be lower. I think in the example I've got on the board, it moves to delta 30. So we've sold a lot of stock. The delta of the call option has decreased. So now we're actually short deltas. We need to buy some more stock back to ensure our position stays hedged. So we buy some stock back at 92. The next day, overnight maybe, some positive Rio news, positive mining news comes out. The stock skyrockets up to 100. The delta of the call option is now really high. It's close to 1. It's delta 90 in this example. So we have to sell, I think in the example, 3,000 more shares at this price of 100. So we're selling shares here at this price of 100. And the next day, the stock moves back down to 95. So we've got to buy some more shares back to hedge our risk. So we're now at 95, again, where we bought the stock. We've bought and sold shares at different prices. But if we think about it, this trade has allowed us to sell shares at 96 and 100, buy shares at 95 and 92. We're buying low and we're selling high. Having this option position and ensuring that it stays delta hedged has allowed us to actually make money on the trades of the underlying. And this also makes sense if we just think about trading one stock. I said before this is hedged for small moves of the spot price, but we can see that for bigger moves, because the delta of the option varies, whereas the delta of the stock price is fixed, the payoff diagram looks something like this. It's actually concave for bigger moves of the stock, and I think it's concave, it may be convex. I'm a little bit rusty on the university maths, but as the stock moves, larger and larger amounts, we make more and more money. So we think, okay, this is maybe a quite an interesting trade. We buy an option, and then as the stock moves, it allows us to make almost a risk-free profit trading the stock. So if this is the case, why wouldn't everyone do it? Why wouldn't you just do this trade? Well, firstly, buying the call costs money. And as we said before, we have a negative exposure as time runs out. So we get closer to expiry, the payoff diagrams, as we get closer to expiry, the price of the call decreases. So you have to pay money to buy the option, and then you lose money every day. So if the stock doesn't move as much as it's implying, as the volatility is implying, you actually lose money. Yes, this trade isn't free. And so then how can we make money doing this? So this comes down to the relationship between how much the stock moves in the future versus how much the market thinks it's going to move. Because volatility is a pricing input to the options price, the market prices a volatility. Call it volatility of 20. This is often calculated historically based on how much the options moved in the past. I gave the example in the past of the Rio stock being very boring, moving in a very small range compared to a stock like Tesla. So a stock like Tesla would have a much higher volatility implied by the market. So higher volatility means that options are more expensive. It costs more to enter into this position where we can try and scalp or buy low and sell high as the options move. So then we think, okay, the market has this fair volatility price, this options priced off of. We need to make a prediction of how much the stock price is going to move in the future compared to that fair volatility, and then we can see whether we're going to make money or not. So I've got on the slide here, realized volatility gets backwards looking. It's a variance measure of the underlying. So I've got a few steps here about how you can calculate the realized volatility of a stock. So it's to do with calculating the daily log returns of each day in the past, find the standard deviation of these returns, and then annualizing this number. So using the Rio example, maybe someone's done this calculation and come up with a volatility number of 16. So this means on an annualized metric, the stock moves about 1% a day. But we think, okay, I know maybe some big Rio news is going to come up. It's going to move a lot more than 1% of the day in the future. We can buy this option, and if the stock moves more than what the market is implying, we'll make money scalping like this. And if it moves less, we've made a poor trade because we've paid money to buy this call, and then the time value has come out as we've moved closer to expiry. And if the stock just stays here, if it doesn't move at all, we can see we've got no opportunity to buy low and sell high. So we're sitting on this option that we've paid money to buy, and it's just losing money without the stock moving. So yeah, this trade-off between coming up with what you think a fair value for the realized volatility is, and then comparing this to the market's implied volatility is interesting. And yeah, if you get it right, you can obviously make a lot of money doing this trade, but yeah, it does expose you to some risk. I'll touch on one final topic just towards the end here. This is a bit more of an advanced topic, the concept of volatility skew. So we can think here, say the Rio stock's trading at 95 at the moment, and we can think about the 90 put and the 100 call. Maybe you could make an argument that these are both should be worth about the same amount. It's probably about symmetric whether the stock will move up $5 or move down $5. So this call and put could have a similar price. In reality, and I'll just talk about indices here, for stocks this doesn't often hold, the puts are actually worth more. So if we draw what we call a volatility curve, so the implied volatility across the strike price, we can see the volatility implied at the strike of 100 is much lower than the volatility implied at the strike price of 90. The main reason for this is the idea of hedging that I talked about before. People are generally longer stock, so they like to hedge their downside risk. This means they buy puts, so they're buying options that have a strike price lower than the current price of the stock. Also, if you think about an index like the ASX or the Nikkei or the ES, what reasons or what news would have to come out for the value of the ASX to be 10% higher a week from now? There isn't much that can positively affect a whole economy that much. Whereas I could think of 5 or 10 reasons, natural disasters, war, pandemics, why whole indices and whole economies lose 10, 20, 50% of their value in a week. This kind of black swan event, these tail risks, this is also part of the reason why these downside options are worth a lot more than the upside options. In March, for example, indices dropped 20 or 30% in 3 weeks. These put options went from being not worth very much to being hugely, hugely in the money in a short amount of time. A lot of people made and lost a lot of money. And so, people are hedging against these really extreme market events. And it's really this like supply and demand phenomena that causes this volatility curve to be skewed a little bit, to be tilted, and the downside options to be worth a little bit more. So just to finish, I'll chat about some of the required skills of a trader at IMC. So a few of the degrees that we're looking to hire from include science, engineering, maths, stats, actuary, finance, economics, generally quantitative degrees. We care a lot about quantitative skills. We're looking for people that are avid problem solvers. So they've got a flair for numerical analysis. They're often comfortable with numbers, doing quantitative calculations. We also want people that are competitive, driven to win, and they thrive in a team environment. As I've touched on in a few of these examples, trading's a zero-sum game. When you buy a contract against someone, your payoffs are often inverted. So IMC, we're a team, and we're competing in the market against other teams. So we want people that are competitive. They're willing to work in a team because 1 + 1 in these environments is often bigger than 2. When 2 people work together, it's often better than just 2 people working solo, not sharing ideas at all. You want to be able to come to work every day, and you want to be able to win. You want to kind of beat other people in the market, and if that excites you, that's really kind of what IMC is looking for. We're looking for people that are resilient and comfortable making decisions under pressure. The market can often be very fast moving, and you often have to make decisions with a small amount of time to react. One of the positives of IMC is that you get given a lot of responsibility early, but this means that the decisions that you make do have quite big impacts even early on in your career. So ideally you're comfortable making decisions under uncertainty, under often small amounts of time or large amounts of time pressure. And then we're also looking for people that are passionate about financial markets. All this stuff is great in theory. In reality, you're trading actual products, actual contracts against other people in the market. There's no prior knowledge or experience of finance required, but we're looking for people that really do enjoy this kind of stuff. And if that sounds like you can find job details and job descriptions on IMC's website. Just Google IMC trading, and there's a bunch of careers pages there. And stick around for the Q&A. If you've got any questions about things I've asked, or what it's like being a graduate trader at IMC, working here as a first job straight out of university, happy to answer all of those. So thank you for listening.